Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meisinger. Welcome back to the ISE webinar series. Today, I have Rick. I actually don't have Rick. Rick's not with us today. Shawn Howell's with us from Pro Market Advisors. Normally, they work as a tandem, but Rick was unavailable today. Shawn's going to handle the whole presentation, which he's fully capable of doing. And he'll be talking about beyond call buying. So essentially what that means is that you can always buy a call, and you're hoping that the asset moves up the ETF. Well, you might want to consider other strategies. Shawn's going to go through that, such as spreads. And he is been in the business for a long time. He and Rick make up Pro Market Advisors, and he'll talk more to that point in just a brief few moments. Without further ado, I want to introduce Shawn Howell. Shawn, how are you?
Hey, Steve, I'm good. I just saw that I came off mute, so thanks for giving me control now at this point in time. You let me know when you want me to start getting into the slides. I know we've got a little bit of disclosures to go through.
I'm just going to read the disclaimer, and then you're good to go. Just want to remind everyone that whatever Shawn talks about today, of course, should not be construed as investment advice. He'll be giving some examples. And that's all they are examples. Taxes, margin, and commission are not included in any of his examples, and they, of course, are very important factors. If you get a copy of the characteristics and risks of standardized options, you can get it through your broker or at optionseducation.org, 1-888-OPTIONS. Shawn really does a great job every time I've worked with him, so I'm sure it'll be no different today. And really, Shawn, it's up to you now. I'm going to pass the ball. And let me make you the presenter so that you can share your desktop and deliver your presentation. Thanks for joining us at the ISE, Shawn. Appreciate it.
Great. Thanks, Steve. So let me just go ahead and be sure. I'm going to move forward here in a slide. You can see a picture of Rick and I there. That's probably not the most exciting thing, but let's go ahead and start getting into this. Be sure that you've got post-future webinars. Steve, did you load up my slides?
I didn't download your... I was hoping that you were just going to show your desktop. That's okay?
Yeah, hang tight. Let me go ahead and let me...
Sorry about that. Maybe miscommunication on my side. I did get it, but I didn't throw it in a PowerPoint or anything. Sorry.
No problem. It'll just take me a second here to get that up and running.
Sorry about that, Shawn.
Hey, we're good. We're absolutely good, Steve. Let's see. Let me find my slides. I had them up earlier. Let me know what you can see there, Steve. Are you seeing my slides?
I think it hopefully come... Yeah, a little bit slow, but once it comes up, it'll be fine. Let me just.
I'm gonna try a different. I'm gonna try a different way of going in here. So hang on, Steve. I'm gonna go to a share application here with this guy.
It looks a little distorted on my side.
Yeah, I think it'll be a little bit easier if you've given me the ball. Share application. Share presentation. Okay, let me find that real quick in a different file, and we'll be off to the races here. Steve, if you want to talk about those other upcoming webinars, I'll give you a second to load up.
That's fine. I just want to remind everyone that we do 2 webinars each Tuesday. So we have the currency webinar at 3 p.m. Eastern, and then we have the ETF webinar at 4:30. Shawn is just going to show his desktop, and he'll be able to deliver his presentation. So I do apologize.
Okay, should be loading up here right now. I can see it's WebEx loading the document. You know, even though this is going to cost us about a minute or two of time, I guess it's not the worst thing in the world considering I'm presenting from the West Coast and you're presenting from the East Coast. The fact that we're not having to put this thing on the Pony Express or UPS or FedEx or anything like that. This is still a pretty impressive piece of technology.
I don't see anything now. I just see
uploading.
event in progress.
Yeah, should give it a second here, Steve. I think you're going to see it.
Okay. Okay.
I'm keeping my fingers crossed. You know, while that's getting loaded here, let me kind of talk about the premise for the presentation that I built today. What I found, and I've been a trader and I've been a broker back to the mid-'90s here, is that when people begin to learn options, they kind of learn from the most basic concepts to the advanced. And the unusual thing about option trading is that when you start with basic concepts, let's say you just start with straight buying a call or buying a put, it becomes very difficult for people to determine the delta or the direction of the movement of a put or a call. If you think about what the market can do, you buy yourself an option, doesn't matter if it's a call or put. The market can go up, down, or sideways. Well, of course, with any kind of an instrument with time decay, like a call or a put, you're going to lose money if it goes sideways. So with a call, you have to have some price performance pressure. And what I've found as people start going down the path of option trading is that when they buy these call options, they typically go for the cheapest ones. So they're going to buy the out-the-money call option that is the shortest time frame so they can keep this transaction cheap, which is really very much like gambling or buying a lottery ticket. And when they go and they lose on that position, they don't seem to understand that the reason they lost on that position was not because the option itself was bad, but it's because you get what you pay for. And that cheap option pretty much didn't manifest itself in any profit at all. Even if the market went up a little bit, probably didn't clear your commissions and the actual cost or the premium associated with that option. Steve is still telling me it's loading, but it's been in real slow.
I'm going to actually try to get it on my side.
Okay.
We'll see what happens.
Okay, got it.
I think I can do it, and let's see. Can everybody see that now?
Okay, I'm looking on my end, and now when you know it, that WebEx loading document is moving much quicker, and it's almost done. Okay. I've got it on my end, I think, Steve. Yeah, I think I'm up.
Okay, all right. Okay, I closed it. Okay.
Okay, I'm hoping we're there.
Then I'm just going to give you the ball back. Oops,
Well, I'm either seeing your presentation or my presentation, but the fact is I can see the presentation, and that's where I want to be here. Okay, so where I'm going with all of this is the fact is that most people start off doing covered calls and buying calls, and they're typically buying out-the-money calls that are about to expire in a couple of weeks out. Lo and behold, this bad strategy or this lack of really strong technical analysis leads people to lose money more often than not. So therefore, over the years, I've heard from folks, hey, you know, options are for suckers. Options are like gambling. I don't trade options. Options are bad. People don't look at their own strategies and say, I use bad strategy. So because so many people get into options and they don't learn the right way to do them, they don't buy enough time, or they don't buy more time than they think they're going to need, they don't buy the right deltas. When they go and lose money, they blame the option for being a bad instrument, and therefore they don't move beyond buying calls. Well, the fact is, everyone on this presentation is at that stage right now where you've already moved beyond them, or you're willing to learn some other strategies besides just buying calls and just buying puts. And that's really the idea behind this, is that we're going to take kind of the good that is associated with the leverage associated with options, and we're also going to take some of the good things that come with covered calls. If you think about your own option path, unless you had some formal education through OIC or through many of the firms that are out there and even some of the brokers, you probably started off doing covered calls against positions that you had in your portfolio. And I've seen many people go and teach folks that covered calls can be used as a strategy for deriving income from stocks and exchange-traded funds that are not going the way that you anticipated. So it becomes kind of a plan B strategy. Okay, so you bought the stock at $30, and now it's at 25, and now you're going and learning a covered call strategy to sell a 27.5 strike price against that, and you're bringing in, let's go ahead and say 25 cents. So you're bringing in a small amount of money with a stock that is already going down, and you're trying to use a covered call as a repair strategy. Well, that's the wrong way to use a covered call. The right way to use a covered call is basically in a bullish to neutral market, not in a bear market. So I find that people get started on covered calls and buying calls, and they do it the wrong way. And again, they go and they blow the account up, or they have a negative experience, and they associate that with the option. Now, let's talk about some advantages of just buying call options before we can get to combining long call options with short call options in a spread trade. The first point that I think attracts folks is increased leverage. So I often hear people selling option strategies as, hey, so if you don't have enough money in your portfolio to buy 1,000 shares of Apple Computer, then the product for you is going to be an option contract, specifically a call option, because you get this increased leverage. Well, my point would be if you didn't have the ability to buy Apple Computer outright, then yeah, definitely you can use an option for leverage, but that doesn't mean that you need to over-leverage an option. And what I mean by over-leveraging is people buy something that is too far out the money. And I've heard it from people all the time. They'll say, well, look at how much money I'm going to make in the next month. All I have to see from my stock is I have to see the stock go from 20 to 30 bucks, and I'm going to make an absolute killing. Well, if you look at the chart of that stock, so what I'm saying is someone has bought a very much out-the-money option. They bought a $30 strike price. Think for a minute what the delta or the relationship between that call option and the underlying stock. Think about what that delta is going to be of a $20 stock with a $30 strike price. It's going to be extremely small. It's going to be probably less than 0.10. So we have a very, very low correlation between the movement, but the person thinks that the stock is going to go from 20 to 30. If you look back at that stock's behavior over the past month, even if it is in a bullish trend, maybe it had gone from 19 to 20 in the past month, to think that it's going to go from 20 to 30 in the next month, it's a pipe dream. It's not going to happen. So when I find that people are attracted to options because of their increased leverage, they tend to take this to the extreme, and they try to figure out just how much leverage they can get, not recognizing that the chances of them actually getting a return on their investment are very, very slim. So they over-leverage their positions. This is one of the advantages of buying a call option, but it's also a disadvantage that most people don't do it right. Another thing that I absolutely love about an option, and I think this puts people at ease, is that there is absolute defined risk. Your loss, as I'm sure you're aware if you're on this webinar today, is that it's defined by what you paid. Your losses are absolutely limited. You can't lose more money than the premium plus the commissions that went with that. So this allows people to go in and buy some high-flying stocks like Netflix and Apple and Google and stocks that otherwise they couldn't afford, or they couldn't sleep at night because they had such a considerable amount of their equity tied to that option as well. So 2 points, increased leverage and defined risk. Well, I love defined risk trading, and I also love number 3, unlimited reward. Okay, so yes, if I did buy this stock, and I did buy a stock ETF or index, and I did go and pick up a call option as well, look, I have unlimited reward. Everyone wants to be a dreamer, and what happens if my stock goes from 20 to 30 in a month? Well, wow, I'm going to make a ton of money on this. Or what if it goes, well, an Apple Computer kind of trade? What if it can go from 100 to 200 in a matter of 2 or 3 quarters? There's absolute unlimited reward here, and people love that. But when they see the unlimited reward, what I always go back to them and say, take a look at the chart. Both my partner Rick Swope and I are very much into technical analysis. Go look at the charts and work off of the assumption that what the stock or ETF has done in the past month or 2 or 3, or depending on however long you're going to be in the call option. Build a strategy that plays into its previous behavior. Don't assume that it's going to start doing something more extraordinary in the next month that it hasn't already done in the previous month. And this is particularly true when you have a bull market or a bear market. Remember that when you look at the overall indices, the Dow, the NASDAQ, the mid-cap, the Russell, if everything is trending up, basically you've got yourself in an uptrend. And a lot of that rising tide will lift all boats. Think about how much has it been lifting the boat that I'm betting my money on using this option contract, and understand that it's probably not going to necessarily accelerate, but it probably won't decelerate, and utilize a strategy that allows you to make money based on a typical trading month, 2 months, trading quarter, 3 months, or trading year, however long you want to take a look at. So I love the fact that there's unlimited reward as well. Well, it's not all rosy, as we know. So let's go ahead and talk about some of the disadvantages associated with the option, with buying calls as well. We already know that every option, doesn't matter if it's a call or a put, is a decaying asset. We've got theta decay. Every day that we hold an option contract, a little bit of that value is going to melt away. We also understand that that value is not necessarily going to be linear, that as we get closer to expiration, the theta time decay curve is going to become steeper. And so we're going to be melting faster as we approach. And I'm sure you've probably seen before that the last 3 weeks we have a dramatic increase in time decay. And the last 6 weeks we also have an increase. So the way that I build my option strategies, and the ones that I'm about to talk about today, is I play into that decaying asset, that time decay. And I'm going to do that by selling a little bit of premium as well and try to neutralize some of the cost associated with one side of the spread by selling another side that benefits from the time decay. When you simply buy a call or you buy a put, you've got a decaying time asset. If it does not move in the direction that you forecast it would, you're going to be losing money. Now, the good thing about that is I think it forces people to think about a get-out plan. How do I salvage this trade? And this is one of the things that Rick and I talk a lot about. Hey, if it's not going the way that you thought, time is anything but your friend in this case. Now, of course, there's many time decay strategies that go slightly beyond this one, but this would be kind of the gateway to talking about time decay strategies here. So you've got to consider the fact that they're decaying every day that you own them. This is also one of the reasons that when I put on a spread, when I do a debit spread like I'm going to talk about today, I prefer to put it on a Monday. And when I put on a credit spread, I prefer to put it on a Friday. That way I can take advantage of the positive time decay in my favor. Whereas today I'm talking about a bull call spread. That's going to be a debit spread. Well, another point about call options is that it will require for you to make money to offset the time decay. It's going to require a directional price movement. It becomes a do or die kind of option. If you buy you've got your stock trading at 20 and you buy a $20 strike price, let's say you pay $1 in premium, we've got a break-even calculation of the strike price plus the premium, so we've got to get to $21. Maybe you've bought an option that's going to last for 2 months. It's do or die. It's got to get to 21 bucks, or I begin salvaging what is left. Of course, if it doesn't make any movement in the direction of $21, if it stays right at 20, basically I'm going to be at the money or even slightly out the money at $19.99. I'm going to lose the entire premium. So this is both a good and bad thing. I think it's a good thing because a person recognizes that in their analysis, if they're wrong and this stock or this exchange-traded fund does not begin to move in the amount of time that they have before expiration, their best bet is just close the position out, move to cash, and then look for the next best opportunity. So I do like the fact that it forces action. One of the most dangerous things that I have seen in my career as a broker and my career as an educator is that I've seen people say, you know what, so it's General Motors. This is old General Motors, not new General Motors. It's a good company. It'll come back. It's just going to take them more time to get their ducks in a row. So I'm okay giving up the dividend. I'm okay that it's down. I'm just going to park this in the back of my mind and in my investment portfolio, and I'm going to give it some time to come back. And, of course, we all know that General Motors didn't come back, and this is the same for many companies out there, including companies like Citi that have suffered a dramatic loss from their highs, and people are sitting around waiting for a company like Citi to come back and be a strong company again. The reason I'm mentioning Citi is that is one of the largest held entities in anybody's portfolio. I know that a broker that we work with, over 10% of their client base owns Citi as one of their larger portfolios, one of their larger positions. So, you know, these are companies that people keep thinking, hey, it'll come back, I just need to give it more time. With an option, you don't have time to give it. So it forces action, which I think is a good approach to risk management. Well, another thing, somewhat of a downside is that if you get into an exchange-traded fund or a stock that has a dividend, you're not going to get the dividend. And if you think about what happens when a company pays a dividend, let's say that you've got a stock or an ETF, again, trading at 20 bucks, and they have a 50-cent dividend, and you happen to own the strike price at 20, and again, you paid $1 for it. Well, when that company goes X, when they go ex-dividend. Ex-dividend is the date that that stock no longer trades with a dividend. That means if you buy it on X date or thereafter, you're not going to get that 50-cent dividend. 50-cent dividend will probably get paid a couple of weeks to a couple of months down the road. Well, if you bought the option contract at 20 and you paid $1 for it, and during that period that you hold that, if that stock goes X and it drops to $19.50, and that's what happens when a stock goes to X date, is that the value upon opening is reduced by the amount of the dividend. Now all of a sudden you pull up your portfolio and you take a look at the stock that closed at 20 bucks, and you pop it open the next day at market open and you see that your stock is opening at $19.50. What's with the gap? Market was pretty quiet. Futures were quiet. What's with the gap? Well, the gap is associated with that dividend of 50 cents that is now an ex-dividend, and now you've got to crawl back from $19.50 all the way to 21 bucks before you break even on that option. So not only do you lose the dividend yield associated with if you had just bought the straight stock, but you're also going to have to contend with the price movement that's going to be required for you to get back up to 20, back up to the at-the-money price, and then you got to get to 21 before you break even as well. And then, of course, there's delta. And I mentioned what delta is. You're probably very aware, but it's the relationship between the price movement of the underlying and the associated option. So unless you buy an incredibly deep in-the-money option, your stock, or I should say your option, is not going to move lockstep with the underlying. If you buy 100 shares of a $20 stock, sure, you put $2,000 into it, and you can basically say, I have 100 deltas. If that stock goes up $1, your portfolio is going to go up $100 because you own 100 deltas. If that stock or ETF goes down $1, you're going to lose $100 because you have 100 deltas. You're long 100 deltas. If you buy an at-the-money call, an at-the-money call typically, for this example, has about a 0.5 delta. So you bought the at-the-money call, the $20 call, and indeed your stock goes up $1. Well, hypothetically, that option should have moved 50 cents because it has a 0.5 delta. Okay, well, that's great. It goes up $1. I make 50 cents. That's wonderful, especially if I paid $1 for that, and it moves the very next day $1 my direction. Wonderful. I can expect that the underlying, or I should say that the option, should be worth about $1.50. It would be worth a little bit less because of time decay. Now, if it goes down $1, you can expect that your option is going to drop by 50 cents, again, because that is the relationship of the underlying to the delta. But the good thing about deltas is that the more that your underlying, or I should say the more that your option goes in the money, the more that at-the-money delta that was at 0.5 will become a 0.7 and become a 0.9. But really, you're never going to see a true dollar-for-dollar movement on the deltas because of things like volatility and the time decay built into that. And I guess you could also say that it's somewhat of a good thing that the more that your option goes out the money, so you bought that $20 strike price, stocks at 19, goes to 18, 17, 16, the more you're going to see the delta drop from a 0.5 to a 0.4 to a 0.35 to a 0.3. Of course, all that really means is that you lose money slower on the way down, but losing money is never a good thing. But the good side of that is that on the way up, you will make money faster the more that your at-the-money option becomes an in-the-money, and your delta will increase with that as well. So keep in mind some of the disadvantages as well. Let's take a look at a basic long call example before we start getting into the spread. I'm taking a look at the SPY, and I took a look at this on January 27th is when I took this snapshot, and this was the pricing of the option, and this is how the chart looked at the time. And you can see that when I took this snapshot of the chart, we were in a very nice uptrend, and we had just reached, I believe that was a 2-year high on the S&P 500. I'm using a 50-day moving average, and you can see that the movement, the distance between the price action and the 50-day moving average was pretty consistent with a slight separation here. You can see how it's getting further apart. When you've got price pulling away from the moving average, the nice thing about that is that's an acceleration of trend. So we've got a divergence of the price from the 50-day moving average. Of course, a deceleration of the trend to the upside would look like a convergence between the price and the moving average. I just happen to be using a 50-day moving average in this one, which is roughly a calendar quarter and one that a lot of both traders and investors have their eye on. So that's the chart that I was looking at that time. So I would go into looking at the SPY with a rather bullish sentiment. So I would look for a bullish trade. And a long call is just that. It's a bullish trade. So let's say that I decided to buy an at-the-money. And by the way, I don't typically buy at-the-money options. I will typically buy an in-the-money option with a delta of 0.7. I'm using a call option basically as a stock replacement strategy. And Steve, let me see if let me know, by the way, if I've got questions. Feel free to jump in. I'll slow down a bit.
You got it, Shawn. You got it.
Okay. I just noticed that I had a couple of in there. I didn't know if you were firing off answers or not. So when I'm looking at an option, I'm not typically looking at an at-the-money, but I think an at-the-money is one of the easiest ways to explain it. Also, I don't look for a near term. I'll look typically 3 months out, 4 months out, 5 months out, because I want to pay less for theta, and you pay less for theta by going out and buying more time. Even if I'm only going to hold the position for a couple of weeks, I'll buy more time than I need, and then I'll sell it back. I'll close it out before I hit the steep portion of the theta curve here. So in this case, I'm looking at an option that expires February 19th. So this was the near-term option that was getting pretty close to expiring. So it's going to have a pretty steep theta curve at this point in time. So I'm looking at the 130, which I can assume has a delta of about 0.5. I mentioned that. And I'm paying $1.69. Well, my break-even point means I've got to go from 130 to 131.69 for me just to break even. What I would do if this option had, what does it have here? About 3 weeks. I would go back and I would take a look. Where were we 3 weeks ago? Is this trend, is this rate of ascent conducive for me at least hitting 131.69? If the answer is yes, then well, at least the 131.69 break-even point is not too painful for it to achieve. But if you were to set something like, let's say, a 134 strike, hey, that would be a much higher rate of acceleration, and I don't see anything in the chart, and I didn't see anything in the volume that would indicate to me that we were going to see an increase in the rate of ascent, nor did I see anything at this point in time that indicated a decrease of rate of ascent or a convergence between the price and the moving average. So my break-even point dictates that I need to see a 1.3% price movement in 22 days just to break even. If my forecast puts me right at about 131.69, then why am I doing this option? If it's going to put me just to break even, why am I doing it? I'm not doing this to break even on a trade. I'm doing it because I'm looking to extract a profit from it. So by doing just a straight long call option, you are putting yourself in a position in which you must have price performance pressure. It has to go up. If it simply goes sideways, if it stays at 129.99, if it doesn't go anywhere at all, of course our 130 strike price is basically in 22 days going to be worthless. It becomes out the money. So I'm always very careful as far as doing my analysis and what I'm going to buy and buying something that will not necessarily ensure, but if it's business as usual with the way that the trend is going, if it's going to be here in 22 days, if it's going to be where I need it to be, what's going to be my return on risk or my return on my investment that I'm calculating?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.